about how to get money out of an IRA. First thing to understand is the difference between a Roth IRA and a traditional IRA. Pretty much any money you take out of your traditional IRA, you are going to pay ordinary income tax on it. For Roth IRA, it's a little bit different. First of all, you are allowed to take out your contributions to your Roth IRA tax-free at any time. So if you put in $20,000 over the past 5 years, you can take that $20,000 out. It's only the growth that you can't take out of a Roth IRA. And please note that is a rule that only applies to Roth IRAs, not to Roth 401ks. I've seen people mess that up. Now, ordinarily, you need to wait till you're age 59 and a half to withdraw the funds from a traditional IRA or the gains from a Roth IRA tax-free. But there are other ways to get the money out a little bit early. First of all, for your first time home purchase, you can take up to $10,000 out penalty-free from either a traditional or a Roth IRA. You have to meet certain requirements to do that. That is a $10,000 lifetime limit. And for a Roth IRA on this and many of these other things, the Roth account needs to be at least 5 years old, or there still may be tax on it. Additionally, you can use money from an IRA or a Roth IRA for qualified higher educational expenses. So this can be used to pay for tuition, books, and fees for yourself, your spouse, your children, or your grandchildren. Again, you still pay tax if it's a traditional IRA. You still pay tax on the gains if the Roth IRA is less than 5 years old, but you at least avoid that 10% penalty. If you have a lot of medical expenses during the year, and it really does have to be a lot of medical expenses, over 7.5% of your adjusted gross income, you can withdraw that amount penalty-free from your traditional or your Roth IRA. Again, traditional IRA, you're still going to pay regular tax, but you avoid that 10% penalty. This is one that I actually learned doing some research on this. If you lose your job and you are on unemployment for at least 12 weeks, you can withdraw money penalty-free from your IRA to pay for any health insurance premiums you have. So let's say that you have COBRA or something while you lost your job, you're on unemployment, you're having enough trouble coming with money to pay for your health insurance, you can use money from your IRA to pay for that. If you become permanently disabled, you can withdraw the money from either a traditional or a Roth IRA, penalty-free, any amount, anytime. But the IRS has specific rules for disabilities. Typically, you're going to need to be found to be disabled by Social Security. But there are some ways where you can qualify for the IRS rule, even if you're not disabled under the social. If you are on a reservist, and if you are called up to duty, you are allowed to withdraw money from your IRA to pay for various expenses regarding keeping your family life going, paying your house, etc. So as long as you're called for duty for more than 180 consecutive days, you can withdraw IRA funds penalty-free. If you have either an adopted child or the birth of a child, you can withdraw $5,000 penalty-free to pay for costs of the birth or the adoption. That withdrawal has to be done within 1 year of the birth or the adoption of the child. One nice thing about this one is you can actually repay that money. So most of these, the money comes out and you don't get to put the money back in other than the standard caps, whatever they are in the year you're doing it. But with this particular way, you can take the money out now and then you can get the money back into your IRA later so it can grow. If you have an inherited IRA, first of all, congratulations. But any money you take out of the IRA will be without penalty. And in fact, depending on the type of IRA, you must start taking the money out typically within 10 years of the receipt of the IRA. It needs to be fully drained. But that is one thing to know that if you inherit an IRA, you don't wait until you're 59 and a half. You take it out and it is penalty free. Now, finally, there's an incredibly complicated rule called the SEPP rule, the substantially equal periodic payment rule. This basically that you retire before age 59 and a half. You cannot have a job while you're doing this. And it basically lets you set it up almost like an annuity, where you say, I will take this amount of money out of this IRA every single year until I die. If you're going to do this, you need to work with a tax professional because it's very hard to mess up the formulas on this. And if you're off by $1, you will pay the penalty on the whole amount that you take out before you're 59 and a half. But if you are somebody who's been putting that money away and you've got, several $1 million in your IRA, you're ready to retire, this can be a way to retire before you're 59 and a half. IRAs are great ways for people without a job to legally avoid some taxation. I'm a big fan of having a Roth IRA or a traditional IRA.